Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello and welcome to Business Line State of Economy podcast. I'm Lokeshwarri. Our guest today is Sandeep Yadav, Senior Vice President, Fixed Income, DSP Mutual Fund. Today we'll be talking about the interest rate trajectory for both US and India, bond yields, and fixed income investment. Hello Sandeep, welcome to the Business Line State of Economy podcast.
Thank you very much, Lokeshwarri.
So let's begin with what's happening in the US. We know that everyone is waiting for the US Fed to begin cutting rates. So, what do you think? When will US Fed begin to cut rates this year? And do you think that the upcoming US elections is going to influence the Fed's decision going forward?
So, Lokeshwarri, I wish I knew when Fed would cut because that will be $1 million question. And we have seen most of the market participants get it wrong in 2023 as well, because markets have been preempting Fed rate cuts and they have not been coming. And if we see last 1.5 years data points, then Fed has been the one who have been right in not cutting the rates preemptively and waiting for longer, because we have seen inflation has ended up being more sticky than what most of the market participants would have expected a year back. So coming back where we are right now, I think this time even the markets, after probably calling wolves so many times, I think the markets are also more pragmatic as we enter the March FOMC. As for me, I personally believe that Fed is probably an institution which has got the access of the best data points and probably some of the best economists in the world. So to take a position against a Fed's given view is quite risky, and I tend to align with Fed, where Fed says that there'll be 75 base point rate cut in this year. Timing, most probably it's going. In fact, I'm pretty much sure that it's going to be in the second half of this calendar year. March, certainly there won't be any rate cut, because we have seen inflation numbers which came for the last month have been much, I won't say much higher, but they have been much stickier than what Fed or what the rest of the market participants were expecting. So there certainly won't be any rate cut in this policy. The chances of a rate cut in the next policy also look dim, the way the markets are coming across. So then it brings to H2. And if you're looking at H2, then most probably the starting of the second half of the year is when we expect Fed to do rate cuts, because one thing is very clear, that the Fed rates right now are in a restrictive territory. Mr. Powell, the Fed chairman, has himself said that the rates seem to be in a restrictive territory. So it's just a matter of time when they do it. I believe that the starting of the second half of this calendar year is probably when we'll most probably see the rate cuts happening. Certainly not in this policy, and most probably not in the next policy as well.
Okay, so second half is what you're saying. But what's your view about the inflation in US? Because it's coming down to about 3 or so, but Fed is targeting 2%. Do you think they'll wait for the 2% or will they move ahead and cut rates because they also have to keep take growth into account?
So I think the best answer would be to quote what Mr. Powell said right after the last policy. He was asked a similar question, exactly the same question that you asked. And I really liked his answer, because he mentioned that we will not wait for data points to worsen too much. What we will wait is for data points to remain the way they are, and if there's consistency, that data points don't really harden from here on, then they will do rate cuts. Now, what that means is that clearly, in fact, that clearly means that Fed is not going to wait for 3.1% to go to 2%. It just means that Fed wants a little bit of confidence that 3.1% probably goes below 3%, goes around 2.8, 2.9%, and that is enough reason for Fed to cut rates. Right now, they are just making sure that they don't make an error of doing a rate cut and then seeing inflation go to 3.7%. So the position that we are in, I am very clear that Fed is not going to wait for a 2% inflation rate, because they have in a way given an indication that they themselves are not waiting for inflation to really drop down to 2%.
But what do you think about the global inflation in general, Sandeep? Because we see the commodity prices have come down quite a bit. And also growth is also a concern, I think, globally. So, in against that background, do you think inflation softening generally across economies, advanced economies in particular?
Yes, I mean, that was the expectation late last year as well. It hasn't materialized, not so much because of the commodities, but largely the services inflation had remained quite sticky last year. So it's not the manufacturing inflation which turned out to be a little bit difficult. If you look at the whole of 2023, what kept on befuddling the markets as well as Fed was that the services inflation remained robust. There were many reasons that were given. So services is, of course, not much to do with commodities. We are looking at um, you're going to a barber, you're going to a hospital, you're going for education and all. So that's really more related to the underlying economic growth, the wage growth, the employment. That is what would usually drive services inflation, because then people have more discretionary income to spend on those services. And for most of the last year, the conversation was that the savings that people made during the COVID time, that was leading to the services inflation remaining robust. We are seeing a little bit of weakening in this inflation. We are seeing little bit of weakening. Uh, of course, the housing has not really surprised by and large to the extent of services, but I don't think the goods inflation has been the primary concern or the primary reason for inflation to be high right now. So everything then literally boils down to how your unemployment rate and how your wage growth is happening in US. And employment, as you all know, has been quite sticky. It Even the last numbers that we saw of unemployment were much better than or slightly better than what market had expected. So till the time the employment remains sticky and the wage growth remains robust, it is quite unlikely that your services inflation and your inflation in general would suddenly crash down. And that is what we are literally seeing over there. Even if we move away from US, we look at UK. Quite surprisingly, the UK employment numbers have also been strong, and that's what's going on right now in the world. While in the past we would usually see commodities crashing down and it impacting the inflation, this time uh, the wage growth has been quite robust, the employment has been quite robust, and that is just in a way not letting the inflation come down in developed countries.
That's very interesting. So, you think in India also is the same story that we have the core inflation that's kind of making the inflation print sticky?
Actually, core inflation, on the contrary, it's just the opposite in India. Core inflation in India has been coming down drastically. And the last number that, and it's been trending down, and it's been trending down for nearly a year and more. And today the core inflation is 3.3% from the, if I'm not mistaken, the numbers which came out day before. And it's quite, if you see that RBI's headline inflation target is 4%, then it's quite low. In India, the headline inflation has remained sticky around 5.5 levels, not because of underlying strength of the demand, but largely because of the volatile food inflation. So suddenly last month we saw vegetable prices spike up. Now vegetable prices spiking up has got nothing to do with a growth being very strong or a employment being very strong. Well, it's a seasonal thing. Suddenly the supply shocks have occurred and you'll see veggie prices going up. So it's just the opposite in India. So it's in India, it's a transitory and the volatile inflation part which is keeping the headline inflation high, whereas something which is much more stable and much more trending, which is a core inflation and which is a reflection of the underlying demand of the economy, well, that's been coming down. So it's just opposite in India.
Okay. So let's talk about RBI now because we are also waiting for rate cuts here. So what is your take? What is RBI going to do? Because like you said, inflation's about 5%, not really coming down much. And we have this big elections, Lok Sabha elections also coming up. So what's your take on RBI policy stance?
Well, that's an interesting question. So while you rightly mentioned, as headline inflation is still up around 5.5%, but we have seen in the past, Mr. Das has said that core inflation is what they really want to look at because core inflation is more sticky. So I think there's enough data for RBI to pause the rates, and there's enough data for RBI to cut the rates. And there's enough justification if they were to do any of those two things. However, seeing in the backdrop of what's happening globally, where global central banks have been delaying their rate cuts, time and again. I would be surprised if RBI were to be an outlier and do rate cuts before we see a strong signal from global central banks also. Now, why would that happen? Well, because inflation is one part, but RBI also has to look at the sanctity of the financial markets. They have to look at dollar rupee and how the currency is behaving, because eventually that also impacts the inflation, as India is a net importer. So I would believe that till the time we don't see strong signals from the global central banks, RBI would not be doing rate cut. Would elections play a part? I don't think. I think for all you know, India may do the rate cuts when elections are just over, but I think it will be more of coincidental rather than causal, because the causality would most probably happen because during that time you will see global central banks also indicating rate cuts, and it's just that both of them will coincide. But I don't think Indian elections are the reason or will be the reason for RBI to do the rate cuts. It will purely be that all the things will most probably align at the same time. In fact, while I'm answering this, Lokeshwari, I forgot to answer one question which you had asked earlier, whether elections would play a part on the Fed's rate actions as well. Well, I don't think so. I think Fed is quite independent in US, and yes, politics do play a part in every country when it comes to central banks. But looking at how the Fed has been quite clear about what they want to do, and they have ignored most of the markets anticipation, and seeing the fact that they have been right also, I think there's enough reasons to believe that Fed will do what they believe is right, and I don't think there'll be too much of political pressure also on them.
But you said that Fed may cut in the second half of this year. So going by that, by the other thing that you said, that RBI is likely to take cues from the other central bankers. So do you think we could expect a rate cut from RBI in the second half of this year?
Oh yes, absolutely, absolutely. I'm certainly expecting rate cuts from RBI in the second half. Uh, dollar rupees should most probably not be a concern, because we'll see a significant inflows of dollars from global bond index inclusion, and of course the normal balance of payments should remain robust. And absolutely, I expect at least 50 base point rate cut when we are sitting in December 2024, barring any untoward event. And if probably the growth and the inflation crash a little bit more than expected, then we could see a slightly more than 50 basis point also. But yeah, 50 basis points remain par for the course for India to do rate cuts in 2024.
So we are already seeing some kind of a slowdown in consumption, right? Because the latest GDP numbers show that private consumption grew at about 3% something. So I think these high rates, which are remaining elevated for such a long time, are beginning to affect consumption. So that could also influence RBI's decision.
Absolutely. And I think I would probably quote Dr. Ashima Goel, who is a monetary policy member. And she has, in the past couple of minutes of the meeting of RBI meeting, she has mentioned, I think it was Dr. Ashima Goel only, it could be Dr. Jayant Verma, but they have mentioned that when India's growth was doing very well and we saw core inflation coming down for the last few months, and they had raised this point that there's a dichotomy over here, there's a paradox over here, because on one side you're seeing your growth not doing very well, and your core inflation is way a reflection of your growth and your economy. And while there'll be noises between these data, but if you look at the trend of core inflation is coming down, and GDP numbers were still strong. So something had to give on, they had to align together, and you're absolutely right. Now probably the GDP numbers are, and core inflation falling are probably, as you said, the consumption numbers and the core inflation falling down are probably aligning together. And yes, the monetary policy members that I spoke about, they did mention that probably rates are too high and that is impacting the growth, but somehow it's not coming in the numbers. And probably now there is enough or let me say, now there's a stronger evidence that yes, the rates might be impacting our consumption, and that might be in fact feeding into our core inflation. And but again, your headline inflation is still at 5.5%, and I'll say the same thing which I said earlier, that it gives enough reason for RBI to cut the rates or pause the rates, because if with your headline inflation at 5.5%, there's enough justification for that. So probably we are in a no man's land, and it's you can pick what you choose kind of buffet.
So, Sandeep, what do you think about the GSEC yields itself? How do you think they're going to move? And what's your view on the yield curve itself?
All right, Lokesh, I am very confident that the Indian yield curve will come lower. I expect yields to drift lower throughout this 2024. And there are two reasons. One is, as I mentioned earlier, I expect RBI to do rate cuts in the second half of this year. And the second is because the demand in Indian bonds is much higher than supply. So if we see, the demand from Indian bonds largely comes from pension funds, insurances, and banks, and they have been growing at more than 10% per annum. In fact, pension funds are growing at 15% per annum or even more. So your demand is increasing in 12-13% range. And the supply, that is the government, the issuances of bonds that government does every year, has been much lower. So for instance, in FY24, it was, if I'm not mistaken, around 6% increment only. For FY25, there's no increment. It's a flat supply. So when insurances will need, and all these big PFs and banks will need 12% more bond next year, but government is not going to supply that and those kind of bonds. There's only one way where your yields could move, that is lower. But both these factors which I mentioned, the RBI rate cut and demand supply, they impact different points of the yield curve. So the RBI rate cuts will impact your shorter end of the rate curve, 1 year, 2 year, 3 year, because your overnight rates impacts the shortest tenor the most. And while it will have a little bit of impact on the longer bond yields also, but it will be marginal compared to the kind of impact they'll have in the shorter tenor. Similarly, on the other hand, your demand supply is more skewed on the longest point of the curve, because PFs and insurances buy 30-year bonds only. Not only, but they are the natural buyers of long bonds. So the kind of demand supply pressures will come in the longest end of the yield curve, but the rate cut will impact the shortest end of the yield curve. Now, where will 10-year be? So I like to look currently, I try to look at the yield curve as 0 to 10 years and 10 to 30 years. So there are two different segments. And because of the demand supply pressures which I just mentioned, I expect the 10 to 30 year to flatten further. I think currently it's going at 7-8 basis point. I think a year back, maybe it was 40-50 basis point. I don't remember. It has shrunk to 10 basis point or even lesser. And I think in the rest of the calendar year, there's a huge reason to believe that this pressure will only increase, and we'll see 10 to 30 year yield curve invert or even flatten further. From 0 to 10 years, there's a possibility. In fact, there's a strong reason to believe that 0 to 10 year could steepen further, because RBI rate cuts will impact your 1 year, 2 year, 3 year much more. And that is the way we look at it. But if you are an investor, I would believe that a 30 and 40 year point of curve is the best place to be in right now, because the duration risk and the kind of actual money and the profit you will make if you put your money in the 30 year will be much more if you were to put it in 1, 2, or 3 years, because a 1 basis point move in a 30 year is nearly equivalent to a 10 basis point move in a 1 year. So that means if your 1 year moves by 100 basis point, your 30-year bond has to just move by 10 basis point to get you the same kind of money. And the way we are, I think the investors should probably prefer to be in the longest end of the yield curve. One final caveat is we prefer to advise our investors to invest in the active funds which have got the longer tenor bond, because timing of exit from the long bonds is also not that easy. So I would advise the investors to be quite careful, because the longest tenor bonds are a little bit more volatile, and probably it's best left to professional managers rather than buying their bonds directly in their books.
I found the point about the supply quite interesting, because we thought that during the COVID, because of the fiscal deficit shooting up suddenly, there's been a excess supply of paper is what we thought. Now it's about 12 lakh crore of government borrowing coming in. Though it's not increasing, there's a lot of supply out there is what I thought. But you're saying it's all getting absorbed, is it? And the demand is higher than the supply.
So that's a very good point you make, Lokeshwari. Before COVID, if I'm not mistaken, our supply was around 5.5 lakh, 6 lakh crores per annum, which was very less. and then it just shot up. I think in COVID it went above 10 lakh crores. You're absolutely right. Today we are probably 15 lakh crores. So if you were to compare with pre-COVID times, it will seem, oh, it's gone up by 3 times. But what has happened is a couple of things. First thing is that India had a huge fiscal deficit before COVID also. It's just that most of it was off balance sheet. So government of India was not borrowing directly from the market, so they were showing a fiscal deficit of 3.5%. But they were making all the PSUs would go with government guaranteed and government backed borrowing, and because of that, government could show a very low fiscal deficit number, but frankly government guaranteed and government backed were also government borrowing in a way, but that was off balance sheet and that came in the corporate bonds. So that's why you would see that India's term premium vis-a-vis overnight and 10-year used to go at 30, 40, 50 basis point because government was not issuing. But if you look at corporate bond spreads, corporate bonds used to go 100 basis point higher because government was borrowing through the corporates. Today, if you see, NHAI does not come to the market so much. So today, government borrows directly and gives the money to NHAI. So that is one part. You're absolutely right. Now, if the supply is so high, why am I saying that the supply is low? Well, I am not really saying that the supply is low. I'm saying that the supply growth year on year is low. So once government borrowed straight away 12, 13 lakhs during the COVID times, last year the increment was just 6%. Today the increment is zero. So that high supply was already priced in the market 3 years back. And since then, the supply is just not increasing. And that is why we are seeing the incremental supply not coming is bringing the yields lower. So let me put it this way. If before COVID, your 10-year was trading 50 basis point above repo and a rate cut was expected, people would have bought it. Your 10-year would have gone just 20, 30 basis point above repo if a rate cut was expected in near term. Today, when most participants expect a rate cut in this year, 10-year at 50 basis point is, is has not moved budged too much lower. Why? Because that supply of 15 lakhs as an absolute number is still high, but that is already priced in. And since this 15 lakh crores of supply which came this year is not increasing in the next year, that is why the incremental supply is not there. So incrementally, the yields will move lower from 7%, is what I'm saying.
Okay, point taken. So, final question, Sandeep. What would you advise fixed income investors in mutual funds or otherwise also?
Well, I won't give one single answer because it depends from risk appetite of one investor to another. But I believe investors who are willing to take risk and who are, and in debt, in debt, when we say willing to take risk, we are not saying making losses of 3-4%. For us, willing to take risk is probably worst of worst. You get 3-4% of return in a year. So, if a debt investor is willing to take a risk, I would strongly say that go in active bonds, which have got high duration right now, and preferably that high duration is in 30 and 40-year bonds because the demand supply dynamic is not going to shift too much, and we will keep on seeing the demand coming. And these rates says at 7.10, 7.15, they're still lucrative, especially when we see rate cuts happening. For people who are not sure, who want to play safe and all, I would say that go into a low duration category or a short term category, because when the rate cuts happen, it will impact 1 to 3 years yield curve, and those bonds should really rally. You probably will not make the same amount of money that a person who's invested in a 30-year maturity fund has. But the fact is, looking at the risk appetite and looking at the fact that there's very little chance of RBI doing a rate hike and all, it does give you a good a margin of safety, and it should still provide a decent returns. So probably a low duration fund or short term fund for people who are risk averse and people who are willing to take a little bit more risk. I will say active funds like probably a dynamic bond fund category is probably the best part. A dynamic bond fund category they should invest in, which has got a higher duration in their funds.
Okay, thank you so much, Sandeep, for that very interesting conversation on interest rates and yields. Thank you and bye.
Thank you so much, Lokeshwarri. Thank you for having me there.